usually when we talk about diagnosing a problem, say like a medical diagnosis, there is this fundamental expectation of precision.
Oh, definitely. Like a clear-cut answer.
Right. Yeah. Break your arm, you get an X-ray, and it displays that unmistakable jagged white line across the bone.
Yeah, and the doctor just points at the screen and says, well, there it is. There is the fracture.
Exactly. It's binary. The bone is either structurally sound or it is compromised.
Mm-hmm.
And, that kind of visible, categorizable reality is deeply comforting to the human mind.
It really is. We love clear boundaries.
But step into the world of macroeconomics and systemic financial risk. And, well, that X-ray machine just completely shatters.
Yeah, it's a completely different ballgame.
The diagnostic landscape we are looking at is incredibly murky. I mean, we aren't dealing with a single patient with a single broken bone here.
No, not at all.
We're dealing with like 1 billion patients, all holding hands, all sharing the exact same interconnected bloodstream.
That is a terrifying but very accurate mental image.
Right. And today our deep dive is navigating those exact murky waters. And I want to speak directly to you, the listener, specifically the learner who reached out to us.
Yes, welcome.
You asked us for a comprehensive, highly detailed audio companion to Chapter 5 of the Reserve Bank of India's foundational text, the chapter on financial stability.
Which is a beast of a chapter, by the way.
It really is. So your goal is to master this material while on the go. You want to glance over the chapter while getting the audio breakdown from us. And that is exactly our mission today.
We are essentially acting as your surrogate audiobook. But, we aren't just going to read the text at you.
No, absolutely not. That would be so boring.
We are going to deeply unpack and contextualize every single concept, every framework, and every data point within Chapter 5.
So you can actually master it. And we're doing that by ripping the plumbing out of the entire financial system to see exactly what keeps it stable. And more importantly, what causes the pipes to violently burst.
Yeah, the bursting pipes are the really important part. But to really understand the plumbing, we have to recognize that the financial system isn't just this, monolithic entity that we casually call the banks.
It's way more complex than that.
It is. It's a dynamic, highly engineered ecosystem built on 3 distinct pillars.
Okay, let's break those down.
So first, you have the financial markets, which act as the vast reservoirs of capital.
The reservoirs, okay?
Then you have the financial intermediaries, so that's the banks, the insurance companies, the mutual funds, and they act as the massive pumping stations moving that capital.
Got it. Reservoirs and pumping stations.
And then, crucially, you have the financial infrastructure. This is the actual, literal, physical and digital piping.
Right, the clearinghouses, the payment gateways.
Exactly. The settlement systems that ensure when money moves, it actually arrives where it's supposed to.
And the reason we are spending this time tearing this engine apart for you, the listener, is because, well, whether you are managing a massive institutional portfolio or, running a mid-sized logistics business, or simply just keeping your emergency fund in a standard savings account.
Which everyone should do.
Right, obviously. But your economic survival depends entirely on the stability of this specific web. If the infrastructure fails, society just stalls.
It grinds to a complete halt.
So the core mission of this entire apparatus, as the text lays out, is to take society's accumulated savings and allocate them to their most productive possible uses. It's the engine of resource transfer.
And historically, we see 2 primary channels for how that transfer actually occurs. You have direct finance and indirect finance.
Okay, let's define those for the listener.
So in direct finance, entities raise capital directly from investors by issuing securities.
Okay, so like a corporation needs capital to expand, so they issue bonds or shares directly to the open market.
Exactly. They go straight to the source.
I always think of direct finance as like a massive farmer's market.
Oh, that's a good analogy.
Yeah. The buyer, you walk right past the whole commercial supply chain and you buy the tomatoes straight from the person who grew them in the dirt.
Fresh off the vine.
Right. It is peer-to-peer.
Yeah.
And ostensibly, it cuts out the friction and the cost of a middleman.
Yeah, theoretically. But then, on the other hand, you have indirect finance, which is the supermarket model.
Right.
The supermarket sits right in the middle. They curate the goods, they handle the complex logistics, they manage the quality control, and most importantly, they take on the risk if those tomatoes rot in the back room.
So as consumer, you just go to the bank, deposit your money, and let them figure out who to actually lend it to.
Exactly. That's a highly effective way to visualize it, but it begs a really critical question about the architecture of developing and emerging economies.
Oh, yeah. Like, why do they prefer one over the other?
Exactly. If direct finance, the farmer's market, theoretically removes the friction and the fees of the middleman, why do economies like France, Germany, and, specifically India rely so overwhelmingly on the supermarket model of bankled indirect finance?
That is the big question.
Yep.
Because the text emphasizes this heavily.
It does. In India, banks are not merely the main source of credit for households and massive corporations alike. They are fundamentally the primary vehicle for national savings.
Well, I would argue it comes down to the physics of risk absorption.
Risk absorption, right?
Yeah, and the sheer scale of capital aggregation required for modern industrial growth. I mean, let's say I want to build a state-of-the-art semiconductor manufacturing plant.
Which is incredibly expensive.
The capital expenditure required is just astronomical. If I am forced to operate purely through direct finance in an economy where retail investors might not have the sophisticated risk appetite to buy my unproven corporate bonds.
Right. Grandma isn't buying a 20-year bond for a semiconductor startup.
Exactly. So my options are severely limited. I can drain my own retained earnings, which won't even cover the foundation of the factory.
No.
Or I can try to cobble together equity from a massive, fragmented pool of direct investors, which is just wildly inefficient.
It's nearly impossible at that scale, and that's exactly why the scale required for true economic development demands an intermediary. You need someone who can aggregate that fragmented capital.
A bank.
The bank. Because when a retail saver deposits their funds into a bank, that individual saver is incredibly risk-averse.
They want their money safe.
Right. They want their principal guaranteed, and they want liquidity. They want the ability to withdraw it on demand whenever they need it.
Which is the total opposite of what a factory builder needs.
Exactly. So the bank performs a sort of alchemy here. It pools millions of these small, liquid, risk-averse deposits and transforms them into large, illiquid, long-term, risk-bearing loans for your semiconductor plant.
And if my semiconductor plant goes bankrupt, which happens, the saver doesn't lose their deposit.
No, they don't even notice.
Because the bank absorbs the blow on its own balance sheet. The supermarket takes the loss on the rotten tomatoes, not the shopper in aisle 4.
That's the beauty of it. The intermediary absorbs the risk, allowing the saver to sleep at night.
While simultaneously ensuring that promising capital-intensive enterprises aren't starved of the funding they desperately need to drive GDP growth.
Exactly. That alchemy is the bedrock of economic progress. And when the engine is well lubricated, it functions beautifully.
Why?
But because this engine is built on layers of assumed risk, massive leverage, and deep interconnectedness, it is profoundly vulnerable to systemic failure.
Which brings us to Chapter 5's real focus.
Yeah.
The nightmare scenario.
Yeah.
Because we talk a lot about risk in finance, but systemic risk is a very, very specific beast.
It is. It's not just a bad day at the stock market.
No, it isn't just a single institution making a bad bet and going bankrupt. The text defines it as a breakdown so severe that the provision of necessary financial products and services is impaired to the point where the actual real-world economy is damaged.
We're talking jobs, manufacturing, supply chains.
Everything. Systemic risk is usually analyzed through two distinct dimensions, right?
Yes, the time dimension and the cross-sectional dimension.
Okay, explain the time dimension first.
So the time dimension tracks how risks incubate and compound over the macroeconomic cycle.
Over time, obviously.
Right. During a prolonged boom, interest rates are often low, asset prices are soaring, and overall market confidence borders on pure euphoria.
Everyone thinks they're a genius in a bull market.
Exactly. And this is when the real danger actually builds. Leverage increases. Institutions take on slightly riskier loans because the booming economy masks the underlying fragility of those borrowers.
It's the paradox of stability. Prolonged stability actually breeds instability because it encourages aggressive risk-taking.
People get complacent.
So that's the time dimension. Then you have the cross-sectional dimension, which is entirely about interconnectedness at any given snapshot in time.
How exposed are these massive institutions to one another?
Right, through derivatives, interbank lending, shared assets. And I want to upgrade the standard metaphor here if I can.
Oh, for it.
Because people often compare systemic risk to a game of Jenga.
Sure, you pull out the long block at the bottom and the whole tower falls.
Right. But Jenga implies a slow, mechanical, localized collapse. Modern systemic risk, modern cross-sectional risk is much more like an electrical grid cascade.
Ooh. Ooh, a cascade failure. I like that.
Yeah. Micro risk, the failure of a single isolated bank, is like a tree falling on a power line in a rural neighborhood. A few houses go dark, but the grid manages it.
It routes around the problem.
Exactly. But systemic cross-sectional risk is a massive load-bearing transformer blowing out in Ohio. Suddenly, the massive electrical load that transformer was carrying doesn't just disappear.
No, it has to go somewhere.
Right, it is instantly rerouted to the neighboring transformers in Pennsylvania and New York. Those transformers are instantly pushed past their capacity, so they blow,
And then in milliseconds, the failure cascades.
plunging half the continent into darkness.
And we saw this exact electrical grid cascade play out in terrifying reality during the 2007 to 2009 global financial crisis, the GFC.
The ultimate real-world manifestation of this chapter.
Yes, the initial blown transformer there was seemingly isolated. It was subprime mortgages in the U.S. housing market.
Which, honestly, if the system wasn't so hyper-interconnected, a localized real estate downturn in Nevada or Florida would have just meant bad quarterly earnings for a few regional U.S. mortgage lenders.
It would have been a blip, but those local mortgages had been securitized.
The bundle.
Yes, they were bundled together into complex collateralized debt obligations. They were stamped with AAA ratings by the agencies and then sold to institutional investors, pension funds, and banks all over the planet.
So the risk was explicitly engineered to be cross-sectional.
Precisely. They purposely spread it everywhere. So when a critical mass of U.S. homeowners began defaulting, the value of those globally distributed mortgage-backed securities just plummeted.
And a major bank, sitting in Frankfurt or London, suddenly realized that billions of dollars of assets sitting on its balance sheet were functionally toxic.
Completely worthless.
Yeah.
And because of the opacity of these instruments, no bank knew exactly how much toxic debt any other bank was holding.
So trust just evaporated instantly. I mean, if I am a bank, and I don't know if you are secretly insolvent, I am absolutely not going to lend you money in the overnight interbank market.
And that interbank lending market is the liquidity lifeblood of the global financial system. When it froze, the plumbing backed up entirely.
And this is where the crisis breached the containment of Wall Street and infected the real economy, which is exactly what the chapter warns about.
Right. A mid-sized manufacturing company in Chicago that relies on rolling over short-term commercial paper just to make its biweekly payroll.
Very standard practice.
Very standard. Suddenly they find that the credit markets are totally shut, the banks won't lend, the company can't make payroll, they have to lay off 500 workers.
And then you multiply that by tens of thousands of businesses globally, and you have a massive, devastating economic recession.
The disease jumped from the financial sector to the real economy.
Okay, so if systemic risk is the disease, what is the cure? Because this catastrophic failure forced a brutal reckoning among global central banks and regulatory bodies.
It was a total paradigm shift.
Right. For decades leading up to 2008, the prevailing regulatory philosophy was heavily skewed toward what we call microprudential regulation.
Micro, meaning small. The microprudential mindset assumes that if you rigorously ensure the safety, soundness, and capitalization of every individual financial institution on a standalone basis, the system as a whole will naturally be safe.
You look at Bank A, check its balance sheet, and ensure it has enough capital to survive a localized shock.
Then you do the exact same thing for Bank B.
Which, on its face, sounds entirely logical.
It does.
Let's use a highway traffic analogy. Microprudential regulation is the State Highway Patrol making sure that every single car on the road has freshly replaced brake pads, optimal tire tread, and fully functional airbags.
Everything is up to code.
Right. If every single car is mechanically perfect, the logic dictates that the highway is inherently safe.
But that completely ignores the reality of human behavioral dynamics under stress.
Exactly. I want to push back on the micro-model here. Even if every car has perfect brakes, if it suddenly starts pouring rain and one driver panics and slams on those perfect brakes,
The driver behind them reacts and slams on their brakes.
swerving into the next lane, and suddenly you have a 100-car pileup. The crash didn't happen because of a mechanical failure in any individual vehicle.
Not at all. It happened because of the collective interconnected behavior of the drivers reacting to the same environmental shock.
And in financial markets, this behavioral cascade manifests as a fire sale.
The dreaded fire sale.
Let's say a macroeconomic shock hits. Bank A, acting entirely prudently to protect its individual balance sheet, decides to sell off a large portion of its corporate bonds to raise cash.
A perfectly sound microprudential decision.
Right. But because Bank A is dumping billions of dollars of bonds onto the open market at once, the sheer supply drives the market price of those bonds down.
Basic supply and demand.
Now, Bank B, which happens to hold the exact same type of bonds, has to mark down the value of its portfolio. This sudden drop in asset value threatens Bank B's capital ratios. So what does Bank B do? To protect itself, it also starts selling bonds.
Which drives the price down even further, triggering Bank C and Bank D to liquidate their holdings.
The rational, self-preserving action of the individual institution creates a feedback loop that destroys the entire collective system.
Exactly. And this fire sale dynamic is exactly why the post-GFC paradigm had to shift dramatically toward macroprudential regulation.
Macro meaning large.
Right. Macroprudential regulation isn't just looking at the individual brake pads. It's looking at the density of the traffic, the speed limits, the weather conditions, and the structural design of the highway itself.
The objective shifted from solely protecting depositors of individual banks to protecting the entire economic ecosystem from systemic collapse.
So how do you regulate the whole highway? Because this requires a totally different set of tools.
Let's dive into those specific tools that the text lists. How do they intervene in that time dimension of risk we talked about?
Well, one of the most effective levers is manipulating the loan-to-value, or LTV, ratio.
Okay, how does that work?
In a booming, euphoric real estate market, banks might be tempted to offer mortgages covering 95% or even 100% of a home's hyperinflated purchase price.
Because they assume housing prices will only ever go up.
Right, it's that euphoria. But a macroprudential regulator steps in and imposes a systemic LTV limit, say capping loans at 80% of the property value across the board.
So they are legally forcing the buyer to put down 20% in equity out of their own pocket.
Yeah.
The brilliance of the LTV cap is that it functions as a built-in systemic shock absorber. I mean, if that real estate bubble pops and housing prices crash by 15%, the banking system is completely insulated.
Entirely.
Because the homeowner's 20% equity takes the initial destruction of value, but the bank's loan is still fully backed by the remaining value of the house. The underlying asset still covers the debt.
It's a fantastic buffer. Another critical tool listed is the counter-cyclical capital buffer. And this is perhaps the purest embodiment of the macroprudential philosophy.
Counter-cyclical, meaning going against the cycle.
Exactly. During a massive economic expansion, when credit is growing rapidly and bank profits are soaring, the regulator forces banks to retain a higher percentage of their earnings as capital, rather than paying it all out as dividends to shareholders.
They are legally mandating that banks build a war chest during the sunny days.
Right. So when the inevitable cyclical downturn hits, when it starts raining and loan defaults start rising, the banks already have this massive pre-funded capital buffer to absorb the losses.
Without having to resort to those destructive fire sales we just talked about.
Precisely. They also implement liquidity buffers. This means mandating that banks hold a specific ratio of highly liquid assets, like government securities, that can be instantly converted to cash to survive a sudden, say, 30-day bank run.
And critically, the chapter mentions how they identify systemically important financial institutions.
The CYFIS, the too-big-to-fail behemoth.
Right. Because the failure of one of these interconnected giants would detonate the entire cross-sectional grid, regulators subject them to aggressively higher capital surcharges.
They are forced to carry a heavier structural burden precisely because their blast radius is so catastrophic.
So the global consensus shifts. Regulators realize they need to monitor the entire highway.
Yeah.
But turning academic macroprudential theory into actionable governance, that requires a massive institutional restructuring.
You need an architecture that can actually see the whole board.
Which brings us to how India specifically designed its macroprudential fortress post-2008. The text gives us a very clear timeline here.
Yes, in December 2010, the Indian government established the Financial Stability and Development Council, the FSDC.
Okay, let's look at the composition of this council.
The FSDC acts as the apex-level forum. It is chaired by the finance minister and brings together the absolute heaviest hitters in the Indian economic landscape.
We're talking the governor of the Reserve Bank of India, the chairman of SEBI, the capital markets regulator.
Right, plus the heads of the insurance and pension regulatory authorities, IRDAI and PFRDA.
Alongside the finance secretary, the chief economic advisor, and several other key governmental secretaries.
It was even expanded later, in 2018, to include the Ministry of Electronics and Information Technology.
Which makes sense, acknowledging that digital payment infrastructure is now a massive critical vector for systemic risk.
Absolutely.
Now, let me push back on this structure for a moment.
Sure.
You just listed an incredibly powerful group of people. It's an economic Avengers team.
It really is.
But realistically, bringing the heads of the central bank, the capital markets regulator, the insurance regulator, and multiple massive government ministries into one single room. That sounds like a recipe for absolute bureaucratic gridlock.
Oh, the red tape could be endless.
Right, and financial crises don't unfold over fiscal quarters. They unfold in hours. So how does a massive high-level council like this actually move fast enough to spot and preempt a crisis before it happens?
That is the eternal challenge of any regulatory architecture. High-level councils are totally necessary for statutory authority, but you're right, they are inherently slow.
So what's the workaround?
That is exactly why the FSDC relies on a much more agile operational arm, the FSDC subcommittee, which is chaired by the RBI governor.
Oh.
And beneath that subcommittee operates a network of highly specialized technical groups that do the actual granular, daily, heavy lifting. They are the ones actually watching the radar screens.
Let's dissect how these groups actually function, because this is where the macroprudential theory meets reality.
First, you have the Interregulatory Technical Group, or IRTG. This is purely designed to shatter the silos between different regulators.
Because historically, regulators didn't talk to each other.
Exactly. So if a massive financial conglomerate is moving questionable assets between its banking arm, which is regulated by the RBI, and its mutual fund arm, which is regulated by SEBI, the IRTG ensures the regulators are sharing that data seamlessly.
There is also a dedicated group monitoring those specific conglomerates, right?
Yeah.
The IRFC.
Yes, because if an entity is so large that it spans banking, insurance, and shadow banking, a localized failure in one of its subsidiaries can cause a lethal cross-sectional contagion across the whole conglomerate.
But the most vital operational unit, arguably, is the early warning group.
Oh, absolutely. Their mandate is purely preemptive.
Meaning they aren't looking at historical data to see what went wrong yesterday.
No, they are analyzing real-time high-frequency indicators, credit to GDP gaps, foreign exchange reserves, and corporate leverage ratios to identify vulnerabilities while they are still in the incubation phase.
They are the seismic sensors looking for the tremors before the earthquake hits.
And to process all this intelligence, the RBI internally evolved its own architecture. Right after the GFC, they established an independent financial stability unit,
which eventually matured into a massive, full-fledged financial stability department in 2023.
Right, and the primary output of this department is rigorous, unrelenting stress testing.
Okay, let's talk about stress testing, because it's the ultimate diagnostic tool in the macroprudential arsenal. The RBI doesn't just look at a bank's balance sheet under current sunny conditions.
That wouldn't tell them much. They subject the banking system to severe hypothetical macroeconomic shocks.
They run the doomsday simulations. They ask what happens to the capital adequacy of the top 10 commercial banks if global oil prices spike by 50%, domestic unemployment doubles, and the stock market crashes by 30%, all in the exact same quarter.
They physically model the destruction of capital to see if the banks can survive the impact without crossing the threshold into insolvency.
And they publish these findings in their half-yearly financial stability reports.
Yes, and this transparency is a tool in itself.
How so?
By publicly telegraphing where the systemic vulnerabilities lie, the RBI allows the market to proactively adjust its own risk pricing before a forced correction happens.
It's a beautifully designed fortress of committees, early warning radars, and mathematical stress tests.
It really is.
But a fortress is just theoretical until the enemy actually brings a battering ram to the gates. All this post-GFC architecture had to face an unprecedented trial by fire with the onset of the COVID-19 pandemic.
And COVID-19 was a fundamentally different beast than 2008.
Entirely different.
The global financial crisis was an endogenous shock, meaning it originated inside the financial system due to toxic leverage and corrupted incentives, and then spilled outward.
But the pandemic was an exogenous shock. It came from the outside.
Exactly. It was a complete, instantaneous paralysis of the physical, real-world economy. Supply chains halted, consumption evaporated overnight, and this massive real economy shock threatened to cascade inward and obliterate the financial system.
The central bank had to become the ultimate shock absorber. And the sheer scale of the RBI's intervention here is just staggering.
It's hard to even wrap your head around the numbers.
Between March and May of 2020, as the lockdowns decimated cash flows, the RBI aggressively slashed the policy repo rate by 115 basis points.
Bringing borrowing costs down to historical lows just to keep businesses breathing.
But they didn't just tweak the cost of money, they fundamentally altered the quantity of money. the RBI injected liquidity amounting to 17.2 lakh crore rupees.
And to contextualize that figure for the learner, 17.2 lakh crore is roughly equivalent to 8.7% of India's entire GDP for the 2021-22 fiscal year.
That is massive.
It is a tidal wave of capital designed to ensure that the interbank markets didn't freeze and that credit continued to flow to starved sectors of the economy.
It's an adrenaline shot straight into the myocardium of the economy. But, and this is my big question here, is the profound danger of central banking. Adrenaline can save a patient from cardiac arrest, right?
Right.
But if you pump too much adrenaline into the system for too long, you cause lethal heart attack. How did the RBI physically inject 8.7% of GDP into the economy without instantly triggering hyperinflation or creating massive systemic asset bubbles that would just cause a secondary financial crisis 3 years down the line?
They did it through meticulous targeted plumbing. The RBI didn't just print money and drop it from helicopters.
Right.
They utilized deeply structured instruments like targeted long-term repo operations or TLTROs. They provided this liquidity specifically against high-quality collateral and strictly with banks as the counterparties.
Yeah. So they weren't taking on junk debt. They were trading cash for safe assets.
Exactly. And most crucially, these liquidity injections had strict sunset clauses built in. The banking system knew this was a temporary bridge, not a permanent structural expansion of the monetary base.
So they had a built-in off-ramp.
Right. As the acute phase of the crisis waned in 2021, the RBI began the delicate operation of migrating that surplus liquidity from short-term horizons to long-term horizons, gently lifting short-term interest rates off the floor.
They engineered a soft landing for the liquidity surge, successfully avoiding the runaway inflation scenarios that plagued several other global central banks.
But there is a highly specific, deeply technical accounting mechanism that the RBI utilized during this period that I think we need to spend significant time on.
Let's do it, because understanding this mechanism is the key to understanding why the Indian banking sector survived the post-COVID inflation fight while massive banks in the US and Europe literally collapsed.
You have to dive into the mechanics of HTM and MTM accounting.
Held to maturity versus mark-to-market. This is the absolute crucible of bank balance sheet management.
It really is.
Let's explain the physics of this to the listener. When a commercial bank takes in deposits, it doesn't just leave that cash sitting in a vault.
No, it has to earn a return.
It lends some out, but it also buys massive amounts of government bonds, which are generally considered the safest assets on earth. But the bank has to classify how it intends to hold those bonds for accounting purposes.
And there are two main buckets.
Right. If a bank classifies a bond as mark-to-market or MTM, it means they intend to actively trade it. Therefore, every single day, the bank must report the value of that bond on its balance sheet at whatever the exact market price is at that precise second.
And here's the foundational rule of bond math. Bond prices move inversely to interest rates.
Let's give an example.
Okay, if you buy a 10-year government bond that pays a 2% interest rate, and a year later the central bank raises rates so new bonds pay 5%, your old 2% bond is suddenly much less attractive to investors.
Who wants 2% when they can get 5%?
Exactly. So the market price of your old bond drops significantly.
Now let's look at what happened in the United States to understand the blast radius of this math. During the COVID era of 0% interest rates, banks like Silicon Valley Bank took in billions of dollars in tech deposits.
And they used them to buy long-term U.S. Treasury bonds, yielding barely 1.5%.
Then inflation hit. The Federal Reserve aggressively hiked interest rates from 0 to over 5% in one of the fastest tightening cycles in history.
And the mechanical result was just devastating. The market value of those older, low-yielding Treasury bonds plummeted.
Because banks like SVB had massive portions of their portfolios exposed to current market pricing under MTM accounting, they suddenly had to recognize billions of dollars in unrealized losses on their balance sheets.
And in the digital age, panic moves at the speed of light.
Venture capitalists looked at SVB's balance sheet, saw the massive hole created by these mark-to-market losses, and told all their portfolio companies to pull their deposits instantly.
It triggered a digital bank run.
SVB had to fire-sell those depreciated bonds to meet the withdrawal demands, realizing the losses and instantly wiping out their entire capital base. The bank collapsed in 48 hours.
The perfect microprudential storm.
But the Indian banking system completely sidestepped this exact disaster. And they did it because of proactive macroprudential flexibility from the RBI.
Yes. During the pandemic easing phase, and crucially during the subsequent inflation tightening phase, the RBI allowed Indian banks significantly greater flexibility to classify their massive government bond holdings under the held to maturity or HTM category.
And if a bond is classified as held to maturity, the accounting rules change entirely.
You are telling the regulator, I am not trading this bond. I am holding it for the full 10 years until the government pays me my principal back.
And because you're holding it to the end, the daily fluctuations in the secondary market price do not matter. You do not have to mark the asset down on your balance sheet, even if interest rates skyrocket.
It's an accounting shield. By allowing banks to shift a larger proportion of their portfolios into the HTM category, the RBI built a massive wall around the Indian banking sector.
As global interest rates surged and bond values crashed worldwide, Indian banks were insulated from the brutal MTM valuation losses that crippled their international peers.
It preserved their capital buffers, it maintained depositor confidence, and it kept credit flowing. It was a masterclass in preemptive systemic defense.
The fortress held against the fire. But as we pivot to the current landscape outlined in the chapter, the reality of financial stability is that the war is never actually won.
Never. The battlefield just constantly shifts.
And right now, the global financial system is navigating a highly precarious macro environment. The global trends impacting stability are multifaceted and, frankly, overlapping.
The immediate overhang is the consequence of that aggressive global rate hiking cycle. The European Central Bank, in their recent financial stability review, was very explicit about this.
What did they find?
Sustained high interest rates are acting as a massive drag on the corporate sector. Debt servicing costs have spiked. When a mid-sized corporation's borrowing costs double, their profit margins just evaporate.
Which inevitably leads to a higher probability of corporate defaults.
Exactly, which translates directly into higher loan loss provisions for the banks holding that corporate debt, eroding overall banking sector profitability across the Eurozone.
It's the classic delayed effect of monetary policy.
Yeah.
You raise rates to kill inflation, but it takes 12 to 18 months for those higher rates to actually strangle the corporate borrower.
And speaking of inflation, the International Monetary Fund's recent Global Financial Stability Report highlights a secondary, deeply concerning trend. The global disinflation journey is stalling.
Stalling out. We've seen inflation come down from its peaks, but getting it back down to the rigid 2% target set by Western central banks is proving incredibly sticky.
Very sticky. The IMF warns that if investors realize this last mile of disinflation is going to take much longer than anticipated, we could see a sudden, violent repricing of global assets.
Markets have priced in rate cuts. If those cuts don't materialize, the volatility will be severe.
And this volatility will hit a global economy that is carrying an unprecedented, historically massive burden of both sovereign and private sector debt.
The debt vulnerability is the dry tinder. But the match that could ignite it might not be traditional economics at all.
No, it might be technology.
This brings us to a threat vector that genuinely feels like it belongs in a sci-fi novel, but is currently sitting at the absolute top of the agenda for the Financial Stability Board. The rapid integration of artificial intelligence and advanced cyber technologies into the core of the financial system.
The operational efficiencies driven by AI are undeniable. But from a systemic risk perspective, the vulnerabilities being introduced are unprecedented.
The FSB is heavily focused on the concept of third-party dependency.
Yes. What happens when 50 of the world's largest financial institutions are all utilizing the exact same proprietary generative AI model from a single tech giant to assess credit risk or manage algorithmic trading?
You create a massive, unseen cross-sectional linkage. If that single AI model has a hidden bias or experiences a catastrophic hallucination during a period of market stress, 50 banks make the exact same catastrophic trading error at the exact same millisecond.
Exactly. The interconnectedness isn't just about who owes who money anymore. It's about who is relying on the same lines of code.
And I want to push on the speed aspect because it terrifies me. We are talking about algorithmic trading systems that execute vast volumes of trades based on natural language processing of news headlines, completely devoid of human intervention.
Moving billions in the blink of an eye.
Right. A slightly flawed data input or a coordinated cyber disinformation attack could trigger an algorithmic flash crash, wiping out trillions of dollars of market capitalization before a human regulator can even click their mouse to halt trading.
It's entirely possible.
So if we are fighting these microsecond fast self-learning algorithms, aren't we fundamentally fighting a 21st century technological war utilizing 20th century regulatory weapons? How does an early warning group combat a machine that operates a million times faster than human cognition?
That is precisely the existential dilemma the Interregulatory Technical Group on FinTech is grappling with right now. Regulatory frameworks are inherently reactive and human-paced.
So how do they adapt?
The pivot has to be toward embedding automated resilience into the infrastructure itself. The FSB highlights that a targeted cyber attack on a major clearinghouse, taking the settlement system offline for even a few hours, could trigger a global panic.
It would be chaos.
Total chaos. So regulators are no longer just stress testing bank balance sheets. They are racing to design cyber resilience stress tests. They need to ensure that the digital plumbing has automatic circuit breakers that can sever malicious connections and isolate infected nodes without shutting down the entire global grid.
So against this chaotic backdrop, crushing global debt, stalled disinflation, elevated European loan losses, and the looming specter of rogue AI algorithms, where does the Indian financial system stand?
Based on the current macroeconomic indicators detailed in the text, India is operating from a position of profound, verifiable strength.
That's reassuring.
It is. Unlike many developed economies struggling with growth, India's macroeconomic fundamentals remain incredibly sound. Inflation is moderating within the RBI's tolerance band, the external position is robust, and the government is maintaining a disciplined path of fiscal consolidation.
And the financial sector metrics are genuinely remarkable, especially when you consider the global headwinds. Let's look at the absolute foundational metric from March 2024, the capital to risk-weighted assets ratio, or CRAR, of scheduled commercial banks.
As of recent data, it stood at a dominant 16.8%.
Okay, unpack CRAR for the listener.
CRAR is the ultimate measurement of a bank's shock-absorbing capacity. It dictates how much of the bank's own capital is backing up the risky loans it has made.
So what's the baseline?
The International Basel III minimum standard is generally around 8% to 10.5%. For the Indian banking aggregate to be sitting at 16.8% signifies an incredibly thick layer of armor.
And it's not just that they have capital in reserve. The quality of the assets they hold has improved dramatically.
Oh, massively.
The gross non-performing assets ratio, the percentage of loans that have gone entirely bad, has plummeted to a multi-year low of 2.8%.
Which is a stunning turnaround from a decade ago when the twin balance sheet problem plagued the economy.
So, to summarize the current posture, bad loans have shrunk to 2.8%, while the capital buffer designed to absorb any future bad loans has swollen to 16.8%.
The fortress is heavily capitalized and the balance sheets are clean. It is built to withstand the cross-border shocks that may emanate from global volatility.
It is a testament to the macroprudential architecture we've been dissecting. But there is one final overarching threat vector we must confront, which the chapter ends on.
Yes.
It is the ultimate systemic risk, not just to finance, but to human civilization: climate change.
The integration of climate-related financial risks into the core regulatory and supervisory framework marks a profound philosophical expansion of what financial stability actually means.
The RBI is no longer just looking at interest rate models, they're looking at meteorological models.
Exactly.
For a lot of people, linking climate change to a bank's balance sheet feels, well, abstract, but it is violently concrete.
It breaks down into two distinct avenues of destruction: physical risks and transition risks.
Let's walk through the mechanics of physical risk first. Imagine a massive consortium of banks that has provided billions of rupees in syndicated loans to develop a sprawling coastal agricultural zone.
And those loans are modeled on historical crop yields.
Exactly. They assume the next 20 years will look like the last 20. But climate change fundamentally alters the historical baseline.
Sea levels rise.
Unprecedented cyclonic activity drives saltwater storm surges miles inland. The soil becomes heavily salinized.
The crops fail entirely, not just for one anomalous season, but permanently.
And the massive agricultural corporations default on their loans. The underlying collateral of the land itself is now functionally worthless.
The banks are suddenly holding billions in toxic, unrecoverable debt. The weather has literally destroyed the financial asset.
That is physical risk, and it is accelerating.
The other side of the coin is transition risk, which is equally lethal to unprepared balance sheets. This occurs not from the climate itself, but from the global economy's forced transition away from a carbon-intensive model.
Let's map that out too. A major Indian bank has, say, 15% of its entire loan portfolio tied up in traditional, massive coal-fired power plants.
Which are currently highly profitable.
But to meet international climate obligations, the government introduces a severe, escalating carbon tax or aggressively subsidizes utility-scale solar to the point where coal just cannot compete on grid pricing.
Almost overnight, the regulatory and economic environment shifts. Those massive coal plants become completely unviable.
They're transformed into stranded assets infrastructure that has no economic utility before the end of its projected lifespan.
The utility companies default on the massive loans used to build them. The bank takes a catastrophic hit to its capital base.
To combat this, the RBI is actively pushing the banking sector to adopt sustainable finance practices. Regulators are forcing banks to run climate stress tests.
Demanding they map their geographical exposure to flood zones and their portfolio exposure to carbon-intensive industries.
They must calculate how much capital they need to hold today to survive the physical and transitional shocks of tomorrow.
It is a monumental task, requiring banks to build entirely new risk assessment models that factor in decades of unpredictable environmental and regulatory shifts.
It is genuinely staggering how vast the concept of financial stability has become.
It really is.
To try and synthesize the immense journey we have taken today, we started by tearing up the floorboards to look at the invisible plumbing of the economy. We explored why direct finance, the farmer's market, isn't enough to power a modern industrial state, and why economies rely on the risk-absorbing alchemy of banks as intermediaries.
We dissected the pathology of systemic risk, moving past the simple Jenga metaphor to understand the electrical grid cascade of the 2008 financial crisis, where localized subprime mortgages froze the global interbank market and crashed the real economy.
We tracked the Great Regulatory Awakening, the shift from the flawed logic of microprudential regulation, where perfectly braked cars still cause highway pileups due to fire sales, to the macroprudential paradigm of LTV limits and countercyclical buffers.
We examined the architectural response in India, the formation of the FSDC, the intricate operational network of its technical groups, the early warning group's radar systems, and the relentless stress testing conducted by the RBI's Financial Stability Department.
We witnessed that architecture survived the ultimate exogenous shock of the COVID-19 pandemic, analyzing how the RBI injected a 17.2 lakh crore adrenaline shot into the economy, but brilliantly shielded Indian banks from catastrophic global interest rate hikes by utilizing the accounting flexibility of held-to-maturity classifications.
And finally, we surveyed the modern battlefield. We weighed the robust, heavily capitalized current state of the Indian banking sector against the looming complex threats of stalled global disinflation, hyper-fast AI algorithmic flash crashes, and the massive physical and transitional risks of global climate change.
It is a vast, interconnected, and occasionally terrifying landscape. But the reason we dive this deeply into the mechanics is because this isn't just theory.
No, it affects everyone.
Every single time you get approved for a small business loan, every time you tap your phone to pay for groceries, every time you glance at your retirement portfolio, you are entirely reliant on this machinery. You are watching this exact, intricate architecture of financial stability operating in real time, constantly adjusting, stress testing, and reinforcing its own walls to protect the economic foundation of your life.
It is the invisible, highly engineered shield that prevents the inherent chaos of human commerce from devolving into societal collapse.
But before we wrap up this deep dive, I want to leave you with a final, somewhat provocative thought.
Let's hear it.
We spent this entire time talking about fortresses. We've talked about capital buffers, rigid LTV ratios, and building thick, unbreakable walls to protect the system from crises.
Building a bunker.
Right. But look at the trajectory of the threats we just discussed. The system is becoming infinitely more digitized, frictionless, and driven by instantaneous AI. Global interconnectedness is only accelerating.
The velocity of risk is increasing exponentially.
Exactly. So the question becomes, will the very concept of financial stability have to fundamentally evolve?
How do you mean?
Well, in physics, a perfectly rigid structure is ultimately brittle. If the shock is big enough, the concrete wall shatters. As we look a decade or two into the future, perhaps the goal won't be building an unbreakable wall. Perhaps true stability will mean engineering a highly elastic financial system,
An elastic system.
a biological system rather than a mechanical one, an architecture that is designed to constantly, deliberately break and heal itself in microseconds, absorbing massive technological and environmental shocks by yielding like water, rather than trying to stand rigid against the flood.
Shifting from a paradigm of mechanical defense to biological resilience. That is a profound challenge for the next generation of central bankers and technologists.
It is the ultimate puzzle, and it is something for you to mull over the next time you swipe your card and trust the invisible plumbing to do its job. Until next time.